Dr. Banerjee, the other aspect that one needs to understand is return expectations from emerging markets. Last year was brutal for EMs. How do you see, the profile, the risk-return equation panning out for 2012?
I see it as being very positive. Emerging markets, usually after a big sell-off, there tends to be a bounce and a recovery. The fundamentals in emerging markets remain unchanged. The capital flows were negative last year on a scale that we only saw in 2008. And post-2008, we saw a strong reversal. I think that reversal will be driven by the high cash position that financial institutions in the developed world carry on their books, especially the insurance companies and the pension funds. So I'm looking forward to double-digit returns out of emerging markets at acceptable risk. So I find it very attractive.
Would that mean 10% plus at least, or you think that we can completely reverse what we lost out and perhaps gain a bit more?
Well, I'm not sure about complete reversal, but I'd be surprised if we weren't getting 20% average, maybe even more. The thing about these flows is that when they start, they tend to be hesitant and then they accelerate if some of the bad news goes away. So you could be surprised at the violence of the reversal. I don't count on it, but it's entirely possible. So I'd be disappointed if it was 10%. I wouldn't be surprised if it was 20%, and not astonished if it was above that.
You were mentioning about how there is perhaps a compulsion almost for FIIs to look at emerging markets at this point.
Well, if we're talking about these markets, it is principally risk reduction, or the perception of risk reduction. Most of these economies, bear in mind, are slowing. China's slowing, India's slowing. Much of the emerging market universe is slowing in its growth rate. Brazil has slowed a lot. So it's not growth per se. The absolute growth rates are still good. The absolute growth rates are at a considerable premium over the developed markets, but they're on a slowing momentum. What is happening is risk reduction. Risk reduction in two ways. One, in the political risk that we've seen in the Eurozone, but a very powerful driver is monetary easing or falling interest rates. We've seen interest rates cut right across the emerging market world. In Brazil, in Indonesia, in Thailand, we're seeing it in, I think we'll see it in India. We have some kind of easing going on in China, and this drives returns. So monetary easing and risk reduction, they're the drivers.
Okay. Last year, BRIC funds lost about $15 billion. Do you think that a sizable chunk of that money is going to come back? Just to take advantage of the trade we were talking about, the dual advantage of currency as well as equity market rebound.
Well, BRIC funds lost 15, and I was just looking at a report the other day that suggested that total outflows were of the order of 48 billion. So they were massive. And yes, I do think they will reverse. In fact, I'm seeing a reversal now. My recent tour of large institutions suggests that many of them are already putting their toe into the water and have a lot of firepower behind it. They will be upset if there's a sudden reversal. They won't be surprised if there's a sudden reversal, say, from a Greek crisis. But actually, at the moment, any pullback is being used by people as an excuse to allocate further funds. So, yes, I think we could get, this is more like 2009 than 2008, in that, or 11, where what we have at the moment is a period of strong fund reversal.
So what's the view in India? Since you've spoken to all these fund managers and institutions, what's the sense in India right now?
It's worth reminding ourselves of the problems before coming out with a positive view, which I do have. The negatives are the twin deficits, fiscal and trade, which are material. We have had hawkish monetary policy throughout all of the last year or so, couple of years, and inflation has been a problem. And the economy itself slowed. In fact, last year, for 1 month or so, in October, we were seeing a decline in industrial production. Now, and of course, we have the political problems. We have the political problems which we all know about, to do with corruption, to do with paralysis on infrastructure spending programs and liberalization programs. They're all negatives. But there is a price for everything. And what we have is too great a fall. Our models, our econometric models, suggest that the fall has been too fast and too deep. And indeed, we're getting some reversal of that. I wouldn't be surprised if the rupee this year was a strong currency, and from a foreign investor's point of view, not a domestic investor's point of view, that means that strengthening currencies attract money, as do for reduced valuations. The Indian market is still 25% or so above the valuations it had at its low in 2008, but it has derated materially. And as we expect growth to continue, and I think inflation has peaked. Inflation is now coming down, food price inflation is falling, still needs to fall further, but I think the momentum for that continues. So it wouldn't surprise me if the central bank in March or thereafter started going on an easing tack.
I was looking at a headline there from you in terms of the kind of gains that you expect from the market, and from the currency as well?
Look, this is a finger in the air. Direction is easy. But again, India should be one of the better performing markets this year. If I think that the rate of return for all emerging markets is in the high teens, India should do 5 or 10% better than that. It will be one of the better performing markets. A rising tide raises all boats. If flows come in, they will rise. India will do better than the average because it has been oversold.
So let's talk about the political situation in India, because there's a lot of pressure to really speed up the pace of reforms, and something to that effect is expected from this budget as well. How will that change things?
I am not confident of deep reforms. The process in India tends to be 3 steps forward, 2 back. The direction is sound. It is one of reform. But we're not there yet, and there are many constituencies that will argue against it. I personally see policy paralysis.
And how do you see that impacting sentiment or fund flows? Do you think this technical rebound will continue, at least till there's a shock, perhaps?
I think unless politicians say disastrous things, which of course they can, the bounce back, which is momentum driven and has to do with an overshoot in the Indian market, will continue. India has the potential to grow much faster than the 7% plus rate that it's getting now, and could grow in the double-digit zone. But there are supply-side constraints, and those supply-side constraints need to be addressed. What foreign investors want to see, what domestic investors want to see, are that those constraints are taken away for the benefit of generalized growth. And so we'll be all waiting for that in order to be able to be comfortable about long-term investment.
What about sectors for investing in India right now? Where do you spot value?
Well, if I am correct, and we are correct, that inflation has peaked and that interest rates are coming down, then the obvious ones are the interest rate sensitive areas. Now, they go into the banks are an obvious play, and alongside that we should look at things like the infrastructure and property and construction. Now, but in rank order, I would probably put the banks ahead of that. In terms of domestic demand, some of the raw material areas might also be very attractive. Now, consumer expenditure in India has remained buoyant. And so while there has been an overselling of the bank stocks and some of the structural stocks, we could talk about them individually if you like, the underlying demand for fast-moving consumer goods, but slower-moving consumer goods like automobiles, is there and will be maintained, and I think that is an attractive area in India from now on.
Where again some sort of decontrol and benefit from the government is expected. Do you think these are opportunities that you would want to kind of study closely?
Of course we would, and we note that in aviation there is talk of foreign investors increasing their exposure to the aviation market. Remember, this is also a function of the fact that the aviation market has been hard hit in this downturn. It's oversupplied for the state of the market, though India's demand long term is huge. And because these companies are in trouble, foreigners are being allowed in. Now, from an investor point of view, the share price action is positive, and so reform there is positive. Retail, we were very disappointed about the lack of reform. I think it would help the man in the street to have the supply chain strengthened, but that is not the view of everyone, and the question really is the government brave enough? Does it have enough support among those within the coalition to bring that through? So we would wait for that reform. We wouldn't anticipate it. And but I think it's less likely that we have subsidies taken away from staples like sugar, which are things that the average man has. So I suspect that, and I'm straying into politics I don't fully understand here, but I think it's easier to cut subsidies in some areas than others. Maybe cap those subsidies, but it's very difficult to be broad-based. So we expect reform. We expect reform to come in stages, and if we saw reform, we would, of course, be excited by it.
Since we're talking about India, give us some of your sectoral or stocks preferences. What are you bullish and bearish on, respectively?
Remember, I thought that falling interest rates and oversold sectors were the areas I'd be in, and then longer term, maybe infrastructure and other areas of growth. So the areas that we would like just at the moment are the banking stocks, like ICICI India, We would like State Bank of India, and in fact we do like them, we're buying them. We look at consumer stocks like Titan, maybe Tata Auto, because within the consumption sector. Coal India is at the infrastructure and production end we would like, but we're nervous about entering those areas, and maybe eventually we'd also look at Larsen & Toubro as a high quality infrastructure play, but that comes later. Now, where are we negative? Well, I'm not so happy about the IT stocks, not because they're bad, but they're facing headwinds from Europe, so we would probably at this point would not be buying TCS or Infosys.
Okay, and from telecom, you're bullish on Bharti?
On telecom, we're bullish on Bharti. We recognize the political handicap that the whole sector is suffering from, but everything has a price, and you have to take into account the buoyant internal domestic market that it operates in, and it's particularly well managed, and the valuations do not reflect that in our minds, so we'd be interested in that. Okay,
while you're avoiding an L&T, is the entire capital goods engineering / construction space something that you're staying away from right now, or selectively are looking at opportunities?
We're not there yet. We think it's a question of timing. Price action suggests that they're cheap, but on the other hand, the political headwinds and the lack of commitment, real commitment to infrastructure spending, holds back capital investment. But we think it's only a matter of time before they come up again.
So technically, I mean, do you expect that there would be like this huge breakout, so to speak, in the Indian market once these events are out of the way and we step into the second half of the year with more clarity coming in on the European and the US situation?
Yes, I think so. I think this could be a very good year. It doesn't mean that 2013 and 14 are going to be as good. Let's be clear that a lot of what we have here is a reflection of the sell-off we had last year and the problems. I can see a very good 2012, but 2013 and 14 and beyond depend on reforms, because we haven't got away from the fact that we have twin deficits and a lack of reform.
Dr. Banerji, it's great to have you on the show. Thanks very much for taking out the time, and wish you all the best.
Thank you very much. My pleasure.